Good morning. This is Horizons Middle East and Africa, our top stories this morning. Central Bank's bonanza. We are awaiting decisions from the Bank of England, Swiss National Bank and Norges Bank. The UK is expected to hold despite inflation going back to 2%. Hezbollah says Israeli strikes in southern Lebanon killed 3 of its fighters on Wednesday. That as a U.S. envoy tries to calm tensions on another front in the Middle East. Plus, China eyes trade war targets across Europe for counter-strikes against tariffs on its electric vehicles. So a lot to get through on the show today. It's just on 8 a.m. across the Emirates. I'm Shimona Versace in Dubai. Just as a reminder, U.S. markets were closed yesterday for a public holiday. But what we did see was another record high for the S&P on Friday, pointing to another positive session today, as you can see from S&P futures, leaning towards the green when the U.S. gets back involved again. So up around 0.2%. As we spoke about yesterday, NVIDIA, largest company in the world now, has overtaken Microsoft. And a lot of that is boosting the outlook for NASDAQ and for some of those tech stocks as well. U.S. dollar also in focus today, trading somewhat sideways, but again, inching towards those highs of the year. It is going to be a mega day for central banks today in Europe. We've got announcements from the Bank of England, from the SNB, and from Norges. So depending on the language that comes out of that, if they are leaning towards dovish rhetoric, then of course that could provide a bit of a boost for the USD, something to talk about on the show. The pound clearly in focus. 127.15 is where we're at, dipping slightly. We've basically been in this 126, 128 range over the course of May. And then the futures in the UK, remember this is a very basic resources and banking heavy index, leaning towards the green as well, up about 0.8%. But it's not just Europe. Let's also check in on how markets in Asia are faring. David Inglis is in Hong Kong. David, it's great to have you on our show, but unfortunately, it's a day of red.
Yeah, well, thanks for having me nonetheless, and I promise we'll probably have something better to talk about at some point in the future. But as you point out, certainly it's a day of risk aversion out there. We didn't really get a clear lead out of Wall Street overnight, but as you can see, right, declines, although volumes are on the lighter side of things, 30% lighter than usual at this point in time. Have a look at where we are in bond futures. So that's the sort of idiosyncratic story we're following in the Chinese market, where this unrelenting rally is continuing here in this part of the world. It's the 6th day in a row that we're seeing upward pressure on Chinese bonds. I'll leave you with a look at the currency markets because, as you pointed out earlier on, it's still a massive day as far as monetary policy is concerned. We're near year-to-date highs, if not there, across most of Asian FX. Dollar peso, dollar China, dollar yen is back above 158. And of course, as you point out, of course, SNB has a decision later today. And I can tell you at this point in time, the Swiss franc is stronger against most of its peers. There we go. That's the short of it here in the Asia Pacific. Back to you.
Yep, let's see what comes out of that SNB, whether they actually decide to go for a cut or not. And certainly there's pressure from a currency perspective. David, good to see you. All right, it is a big day for central bank watchers with, as we spoke about, the Bank of England, Swiss National Bank and Norges Bank amongst the monetary authorities making rate decisions today. The consensus of economists surveyed by Bloomberg is for all of the banks to hold rates, though in the case of SNB, it probably is a bit more finely distributed. So for more on those decisions, let's bring in Bloomberg's senior global economist, Maeva Cousin. Maeva, maybe a good place to start would be with the UK, with the Bank of England. We are coming off those inflation numbers yesterday, headline at 2%, but a lot of people are pointing to the fact that services inflation is still quite high, closer to 6% than 2%. So what does that mean for the Bank of England?
Yes, you're right. Actually, both headline and services inflation actually overshoot the Bank of England forecast yesterday. That's the second inflation surprise since they published their forecast. So that's why no one at the moment is expecting, or virtually no one is expecting a cut today. The big question, of course, is what comes next. Growth has been strong as well, but with inflation at 2% and services inflation continuing to ease down, as well as wage inflation, our colleagues in London think that the Bank of England will actually cut in August and December, but will proceed cautiously. And the risks are for delay to the cut, especially because we also have coming a change in personnel at the bank, where Deputy Governor Ben Broadbent is going to be replaced by Claire Lombardelli. And we think that on balance, it could actually tilt the balance of the committee toward a slightly more hawkish tone in August. So today is the last meeting from Ben Broadbent.
And of course, one major political hurdle out of the way, because we would have had the UK elections by then. Let's turn to the SNB. The Swiss National Bank was the first of the major central banks to actually start the cutting cycle back in March. Today, it feels like the analyst economics community are split about whether or not they should go for another cut. And certainly, they've got to keep an eye on the appreciation of the Swiss franc. So how is that going to be factored into the messaging and the potential decision that comes out of today's meeting?
You're completely right. So it's a very, very close call. If you look at the distribution of analysts, out of 28 polled, 16 are for hold and 12 for cut. Markets are marginally favoring a cut. So it's a very difficult decision. And you're right, the big element that has made this decision finally balanced is what has happened to the Swiss franc, especially following the call by President Macron for a snap election, which has seen the Swiss franc appreciate about 2% against the euro, both on euro effect and safe haven demand. So we think it's going to be a very close call. The main thing is that so far through 2023, the SNB had been supported the franc by selling foreign currency. We think it's actually not very willing to expand its balance sheet again by buying the foreign currencies to weaken the franc. And so that's the main reason why if today they decide it will be a cut, it's really because they keep an eye on the currency.
Yeah, that is true. Though we had a chart up of inflation, and inflation is dropping in Switzerland. And I thought it was really interesting that their forecast for inflation is 1.1% in 2026. It will be difficult to justify restrictive policy. Final central bank of the day that we need to talk about is Norges Bank. They seem to be standing out to me as extremely hawkish versus other central banks around the world. And of course, they are a very oil-dependent economy. Lots of wage pressures there as well. It seems unlikely that we're going to move away from that hawkish rhetoric at the Norges Bank.
Yes, you're right. So nothing coming probably at this meeting. The big question is whether they change slightly their messaging. So far, they had been pointing to a September cut. The question with wage growth still strong, the economy is performing well, as you said, windfall from the energy prices as well. And so the question is whether they will start shifting the rhetoric towards December, in which case they may actually be one of the very, very last central banks in advanced economies to move. And I think that's really going to be the focus of this meeting, September or December. What sort of messaging?
Yeah. Excellent. Well, you are a fountain of knowledge when it comes to central banks and what to watch out for, Maeva. Thank you so much for joining us today on the show. Senior global economist for Bloomberg Economics, Maeva Cousin. All right, let's bring in Maurice Gravier, the Wealth Management Group CIO at Emirates NBD. Wonderful to have you with us. You can take your pick of whichever central bank you want to talk about today, but let's put it in the context of what central banks around the world are doing. I feel that if the likes of Bank of England, SNB do sound dovish, then this would be just another catalyst for the USD trade.
Yeah, for us this year it's very clear. Whatever central banks say, and some are very talkative, some are not, like the SNB, and I praise them for that. They have a very limited leeway for action, and we think that all the Western central banks will start cutting rates. When I say will, some have started. The SNB, the ECB, the BOE will be next, but I think after the elections, because you don't want to be in the spotlight right now. But they will start cutting and not commit to much more because they don't have much leeway.
Yeah, what do you make of this argument that now when people are assessing a world and world currencies, before we were talking about rate differentials, and now we're thinking about safe haven currencies, and we've seen money flow into the Swiss franc for that reason. We've seen a bit of a bid for the USD emerge after those European elections results. Does that continue? Do you think there's enough safe haven premium priced in at this point?
That's a very interesting question, because actually it also explains why gold has decoupled from govies, which was traditionally linked. We live in a dangerous world, and geopolitics are clearly one of the issues we have for currencies. I would say that I think that the rates differential is the most important. Having said that, we're talking about a kind of a derivatives rates differential. That's the trajectory that will matter. And again, we expect central banks to do token cuts, not necessarily commit and engage in a full easing cycle. When this happens, this will move safe-proof currencies. And the safe haven currency, you don't have many, actually. Swiss franc, gold is a currency that is not debt. We like it for exactly this reason. And apart from that, maybe the yen, but the yen is in a different dynamic with a huge question for the central bank as well.
Yeah, well, Maurice, I want to turn to what I think is your home country, French, because of your accent. There's been a lot of scrutiny about French public finances over the last week, a lot of questions about the political trajectory. I'm not going to ask you about the political outcome, but I do want to ask you what markets would perceive to be a positive result out of these elections that are going to take place in a few weeks' time.
Well, that's a nice way to put the question, because actually markets are suddenly, I think that the political situation is not a game changer, it's just a wake-up call, and people are suddenly realizing that the deficits are excessive, and France is going into an excessive deficit procedure with the EU, which is something serious, and this is not because of the Rassemblement National, it's because of decades of public deficits. With regards to markets, well, it's quite clear that what markets would love will probably not happen. I mean, Macron being able to gather a coalition around him, it will probably not happen. The nightmare for markets, I'm not talking about politics, would be the left, because it's led by a very radical left with a very radical agenda. And what will probably happen is a hung parliament with a minority government from the right, which unfortunately means that not much will happen, because constitutional powers are with the president, and they won't do much, so we lose probably a few years for reforms.
I did think it was interesting, though, that the second Marine Le Pen said the words cohabitation, we started to see a stabilization of spreads. And so the markets thought, okay, well, if she's willing to work with President Macron, then maybe that's a good thing. But then you could think about it from another perspective, which is that you're going to have a hung parliament. There's going to be very limited room to pass legislature. Very difficult to come to any agreement on, some of these economic objectives. So I just thought it was interesting to sort of parse together how the market interpreted that cohabitation comment at the time.
I think that, frankly, the market has no reason to panic in the short term, and to see the spread of France against the Bund being comparable to Italy is probably a bit excessive. But the market has very good reason to worry about the long term, because this debt trajectory is not sustainable. We'll have a hung parliament. We won't have the much needed reforms. The right in itself, I mean, Meloni or Viktor Orban, these countries are part of the EU, and they can work together. It's not an issue of politics. It's an issue of debt, I think.
Yeah. Speaking of politics, we have U.S. elections coming up later this year as well. So lots of hurdles to get through still. Do you think the election result in the U.S. could be a major market-moving event?
Again, that's a nice way to put the question. What would be my nightmare? What keeps me up at night? It's not to have a result in November. Not to have a widely accepted result, and that's a major risk.
Result. You mean?
Exactly.
I mean, we'll get a result. It might be contested.
Exactly, because in the current state of the US, this could lead to violence, lots of uncertainty. That's a nightmare scenario. And frankly, we expect volatility to spike as we go closer to the US election. To that extent, next week's debate will be very important. I still don't really understand why it happens so early. Maybe it's a test for the candidates to, I don't know, but that's a burning issue for us. That's the key source of volatility. And when we approach this end of summer, this critical time, will be probably a bit more careful.
Are you hedging?
We're not hedging. We're currently fully invested, because markets are driven by fundamentals, and fundamentals are fine. And we're doing fine in absolute and in relative, but we are, let's say, dancing close to the exit.
Okay, that's a good way to put it. Maurice, don't dance too close to the exit. We're on the 10th floor. Maurice Gravier, Wealth Management Group CIO at Emirates NBD. Thank you. All right, still ahead, UK inflation does fall back to the Bank of England's target range for the first time in almost 3 years. We're also going to discuss how that might impact today's rate decision, in addition to the UK economy, with Panmure Gordon. That's coming up in about 20 minutes' time. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jemana Bersachi in Dubai. Hezbollah says Israeli strikes in southern Lebanon killed 3 of its fighters on Wednesday as a U.S. envoy tries to calm tensions on a second front in the Middle East. So to talk more about what's happening in Lebanon, let's bring in our executive editor for the Middle East, North Africa and Russia, Stuart Livingstone-Wallace. And of course, not just the strikes on southern Lebanon, but also we had a speech yesterday from the Hezbollah chief, Hassan Nasrallah, very strong words, menacing words, I would say. This is a quote. He's saying no place in Israel would be spared. He has threatened Cyprus about the possibility of drawing Cyprus into a war should it actually be intensified. How do you read these remarks?
I mean, I think he's picking up on the reality on the ground, which is that, yes, there's been an exchange of rocket fire pretty much since October the 7th, but it's definitely escalated in the last week or two. On top of that, Israel has come out and said that it has approved a plan for military action in Lebanon. Now, quite what that looks like, we don't know, and there is, increasing guesswork there. But also they're saying that military operations in Gaza are probably going to wind down in the next few weeks. Again, that's a little bit uncertain. So at that juncture where they've wound down in Gaza, and the rhetoric certainly within Israel is that they need to deal with the north. Remember, they've got in the order of 60,000 people displaced from the north, plus, that many, at least, if not more, in southern Lebanon. They're going to have to deal with Hezbollah.
Just seems like certainly a lot of words, a lot of threats, a lot of declarations, and both sides keep talking about the possibility of this quote-unquote total war. But at the same time, Lebanon is on the brink economically, politically. The system is just not functioning. Israel embroiled in a war. How much appetite is there genuinely for both of these countries to engage in a full-blown escalated war?
So the reporting we have from Israel is that it is broadly supported within the population, and largely the feeling is that unless we deal with Hezbollah now, it's going to be a problem in the future, and we're going to have a repeat of what we saw in October. In other words, it's sort of a preemptive strike. Now, quite what that looks like, hard to tell. The assumption would be that they want to create a buffer zone. So we know that over the last several years, Hezbollah has moved closer and closer to the border. It started building these temporary outposts. That was a great concern and probably would have been dealt with at the time, but of course then Gaza happened. So if action does take place, you would assume that Israel will want to recreate that buffer zone. So we're talking about 10 kilometers or thereabouts. That, again, you presume would involve some sort of ground war. The great unknown is how does Hezbollah respond? It is a much more formidable fighting force.
Yeah, there's that, but then there's also Iran. And you've got to think as well, Iran are very domestically involved with the elections that are coming up just around the corner. Yeah. They've been sorting all of that through. And I wonder to what extent that communication, the lines of communication are ongoing now between Iran and Hezbollah. Is there, grounds to sort of hypothesize that in the absence of, Iran being free to, operate post these presidential elections, that they will tell Hezbollah to put the brakes on?
I think so. I mean, I think there's certainly a possibility there, in the sense that we know that over the last 8 months or so, they have definitely held Hezbollah back. The advice, shall we call it, coming from Tehran has been, hold back. Let Hamas do the fighting. And that's largely, I think, because Hezbollah is the great prize. In terms of the proxy forces that Iran has around the region, it is by far the most impressive one. And therefore, I think there's a possibility that Tehran says that it's not worth engaging in full-scale war with Israel. Pull back from the border. Now, quite how you do that and save face, it's really hard to see.
Yeah. Okay. Stuart, thank you for the latest. The executive editor for Middle East, North Africa, and Russia, Stuart Livingston-Wallace. Also coming up, China's counterattack. Beijing considers tariffs on a range of goods from the EU. More on that story next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Now, China is said to be preparing tariffs against a range of goods from the European Union. That is in retaliation for the duties on Chinese electric vehicles. The likely targets include alcohol, cars, and food products. For more, let's bring in our chief North Asia correspondent, Stephen Engel, in Hong Kong. Stephen, it seems as though the way China are going to go about this is a lot more sector-specific as opposed to introducing broad-based tariffs across multiple European industries. What more do we know?
Yeah, I think it's going to be similar to what the Chinese did with Australia, targeting key products that Australia was sending a lot into China, like wine and also dairy and meat products and the like. And of course, now that those tariffs on Australian wine have been relaxed, maybe there will be some tariffs on European products, similar products, as a trade rift starts developing there because of the EU's proposed upwards of 48% tariffs on Chinese EVs. So the Chinese will never call this retaliation. They will just simply say we've launched investigations into dumping by Europeans in various sectors, and a lot of it has to do with foodstuffs like pork, and that would hurt Spain. There's already an investigation, a probe by the Chinese into allegations of dumping by Europeans in the pork into China. There's also an investigation that was launched in January by China into brandy exports. So in other words, in France, that's, cognac is the high end of the brandy. So cognac exports to China, there's an investigation there. And these investigations can take a long time. But like what we saw in Australia, they can do sort of preemptive tariffs as well if it is deemed warranted. So that's what we're seeing. Foodstuffs like brandy, also wine, and that would impact not only France, but Italy and Spain and other Mediterranean growers. And then also dairy, which would impact Denmark, and cars. That's a point of contention with the Germans.
Yeah, most definitely, and even Slovakia as well. But look, Stephen, when they're devising these tariffs or retaliatory tariffs, they are thinking about what they can do to impact the exporter but not harm the Chinese consumers. So are there any products that are going to be out of scope, do you think?
Yeah, that's absolutely right. So they're not going to necessarily slap on a bunch of tariffs on products that China needs. And if you think about, the aviation industry, there's really a duopoly. There's Boeing, which Boeing right now is not selling into the Chinese market. And then there is Airbus. So there has been speculation and there's been some chatter in state media in China that Airbus, these are big ticket items, obviously, that there could be tariffs coming down on European aircraft manufacturing, e.g. Airbus. But again, keep in mind, because they're not buying from Boeing right now, and essentially the Chinese carriers are already in talks to buy 100 Airbus A330neos, there's something they need, and it's something that they're actively pursuing. Why would they add tariffs to something that they're about to buy? So even though there's chatter that this could be a target, it's highly unlikely given the scenarios that I just talked about.
Yeah, it makes sense. It'd be shooting themselves in the foot. Stephen Engel, thank you so much for the latest.
Yeah.
That was Stephen Engel, our Chief North Asia Correspondent in Hong Kong. All right, a quick look at markets before we head out to the break. And you can see that the S&P and NASDAQ are both leaning towards another positive open after a record high once more on Friday. Yesterday, of course, they were closed for a public holiday. Dow seen slightly negative. And then Euro stocks also seen opening up in the green. Big day for central banks. In a moment, we're going to be talking about the Bank of England meeting and what to expect there. We will be speaking to Simon French from Panmure Gordon. We'll be right back. This is Horizon's Middle East and Africa, our top stories this morning. Central banks bonanza. We are awaiting decisions from the Bank of England, Swiss National Bank and Norges Bank. The UK is expected to hold despite inflation going back to 2%. Hezbollah says Israeli strikes in southern Lebanon killed 3 of its fighters on Wednesday. That as a US envoy tries to calm tensions on another front in the Middle East. Plus, China eyes trade war targets across Europe for counter-strikes against tariffs on its electric vehicles. It's just gone 8:30 a.m. across the Emirates. I'm Jumana Bersachi in Dubai, getting you caught up on some of these markets. As we were speaking up before we went to break, yesterday was a public holiday in the U.S., which meant that U.S. equities were closed for trading, but we're coming off another record high for the S&P on Friday. A lot of momentum around tech stocks. NASDAQ, of course, being boosted higher by the momentum that we're seeing in NVIDIA overtaking Microsoft and Apple to become the largest company in the world. We spoke about that yesterday on the show. so. But then the USD is in focus. Again, plenty of central banks on the wires today. If they do sound dovish, that could give another boost to the USD. Today we are trading sideways, but of course getting closer towards the highs of 2024. The pound ahead of the Bank of England meeting sitting at 127.17, so right in the middle of that 126, 128 range that is held over the last couple of months or so. And then FTSE 100, the equity futures are leaning towards a positive start at 0.26% higher, so moderately positive. As we spoke about before, remember that this is an index that is highly geared towards commodities as well as the UK banking sector, and both of which have had a good start to this year. Now, speaking of the Bank of England, the BOE is widely expected to keep its benchmark rate unchanged today at a 16-year high of 5.25%. Now, despite May's inflation rate slowing to the central bank's 2% target for the first time in almost 3 years, price growth in the services sector remains almost triple that level. Traders have only one Bank of England cut fully priced in for 2024, down from as many as 6 at the start of the year. So for more, we're joined by Simon French, Managing Director and Head of Research at Panmure Gordon. Simon, it's good to see you. Good morning. Maybe let's just start with the inflation numbers that came out yesterday, because, again, many in the media were jumping on the fact that the headline inflation number came in at 2%. Great. That's the inflation target. But then, of course, if you dig beneath the surface, core is still running hot. Services inflation, 5.7%. What do you see as the path for inflation going ahead?
So you've broken it down very well there. What you have is temporarily a inflation rate that looks in line with the Bank of England's 2% target, but it is heavily influenced by goods deflation, more than 1% negative print on the goods complex. And you have to say that is unlikely to persist into the end of the year, certainly into next year, given base effects and indeed what we're seeing in global shipping markets. So the bank has to say on a forward-looking view that inflation is likely to pick back up, and therefore it is unlikely to go on a big cutting cycle, quite simply because it can't be confident that you're going to get to 2% as it did in the data we received yesterday and stay there.
Yeah, I mean, the Bank of England, the MPC, have talked about rates having to be restrictive to get inflation back to target. And yet, even if they cut 50 basis points, even if they cut 100 basis points, Simon, they're still actually going to be in restrictive territory. So it doesn't preclude the possibility of rate cuts. It probably just means that when they do start cutting, it's just going to be a shallower cycle.
Yeah, Joanna, you're braver than the rest of the Monetary Policy Committee. You're putting your neck on the block and saying that you think you know where the natural rate of interest is in the UK. And that's not a criticism, by the way, of UK policymakers. Globally, none of the major policymakers, given the inflation interest rate shock we've had, are particularly confident they know where the natural rate is. But I think you are spot on that we've seen commentary, haven't we, from the European Central Bank, from the Swiss National Bank, from the Riksbank, from the Bank of Canada, about cuts that remain restrictive without actually committing to what that level might be. But I think the best commentary probably identifies that the level of interest required in the UK economy when inflation was running at 11% 18 months ago is probably too high for what it needs when inflation is down in single digits.
Simon, this isn't going to be a Bank of England meeting where they're going to release their updated forecast for inflation and GDP. And yet, we've spent a lot of this first segment talking about the inflation outlook. But what about the growth outlook? Because it seems as though the numbers have actually started to surprise somewhat to the upside.
Depends on your expectations for the year. The market certainly thought a growth of 0.4% for the year, which is pretty tepid. I mean, I have to say our house view was for 3 times that, 1.2%. Let's not hang out the bunting if we do get there, which I think we will, given the upgrades you mentioned and the pickup in momentum. That's still close to half the level you would hope for in a mature economy like the UK. But you are right to say it's bought a little bit of time for policymakers because the growth picture isn't as depressed. And this is one of the reasons why markets looking for 5 or 6 rate cuts at the start of the year, now perhaps only getting 1 or 2, are quite sanguine because it has been driven by actually a pickup in growth momentum, not just in the UK, but in most major economies.
Let me turn to the politics, because we've got an election coming up. A YouGov poll came out yesterday suggesting that Labour are on track for a supermajority, a majority of more than 200 seats. And I just wonder how that translates to the economics on the ground, particularly, say, for example, if they push for a higher living national wage, that isn't going to help with subsiding some of these domestic inflationary pressures. So how do you think a Labour government with such a big supermajority could actually influence the economic outlook for this year?
Well, I think the first and most powerful driver of the economic outlook will be stability if a large majority is generated. I think investors historically have quite liked the stability associated with strong governing majorities. But you're right to delve into the micro elements of that. And certainly policy regarding not just headline pay, but also on a broader workers' rights, what that does to the relationship between workers' slack and inflation is one of those things the Bank of England will need to take into account as it goes through the cycle, goes through potentially a cutting cycle. I have to say, though, this incoming government, regardless of the size of the majority, if it is to be Labour, are unlikely to change things big picture, fiscal envelopes, how much tax and spending there is in the economy. They're going to try and gain the confidence of international bond markets, of international currency markets first, and that will probably, in my view, last 12 to 18 months before they start to do anything on the economic front that is particularly radical.
Very clear. Simon, as ever, so good to see you. Simon French, Managing Director and Head of Research at Panmure Gordon. Thank you for joining us today on the show. Well, with less than 2 weeks to go until Britain's general election, UK Business and Trade Secretary Kemi Badenoch and Shadow Business and Trade Secretary Jonathan Reynolds will go head-to-head in a live televised debate moderated by Bloomberg's Francine Lacroix. That is next Monday from 3:30 p.m. in Dubai on Bloomberg TV, online, the Bloomberg Terminal, and on Bloomberg Radio. So you do not want to miss that business debate. Elsewhere, Vietnam has welcomed Russian President Vladimir Putin, who's arrived after his trip to North Korea. His visit underlines the decades-old relationship between Moscow and Hanoi. Bloomberg's Bruce Einhorn joins us now. And Bruce, maybe let's just start with the original summit that happened in North Korea. What were some of the main takeaways from that summit?
Well, this was the first trip by Vladimir Putin to North Korea in 24 years. However, the two leaders did meet in Russia last year in September, and following that meeting, there was a big increase in shipments of munitions from North Korea to Russia, which Russia could then use in Ukraine. This is something that both the North Koreans and the Russians have denied, but there is a lot of evidence showing that this has happened. In return, the Russians have provided the North Koreans with assistance in things like their space program. The North Koreans have ambitions to deploy spy satellites. They have had a few launches with not the best track record so far. However, they are pursuing that. They're going to get more help from the Russians. Kim Jong-un, after his meeting with Vladimir Putin, said that this meeting showed that the two countries now have deepened their relationship, which of course dates back to the days of the Soviet Union, and Kim now referred to it as an alliance. So an indication of just how the two countries are deepening their ties. It could also lead to some complications for China, because this meeting took place at the same time that there was a high-level meeting between China and South Korea. China probably is not enthusiastic about Russia getting more involved in this part of the world. If it then increases tensions in the region, gives the U.S. a reason to deepen its relationship with Japan and South Korea when it comes to their alliance. So maybe China's not thrilled with this in the same way that maybe they're not thrilled with what Putin is doing in Vietnam.
Interesting. Yeah, interesting geographical context there. But When you think about this new strategic partnership or alliance, as you just phrased it, between North Korea and Russia, how worrying is it to the rest of the world? What has the response from the U.S. been?
The U.S. response has been, as you might expect, critical of it. Secretary of State Anthony Blinken issued a statement criticizing this, also criticizing the U.S. is not happy about Putin's visit to Vietnam. The United States would like to see Putin not welcomed in places like Vietnam. Vietnam, of course, has a long history of relations with Russia, and before that with the Soviet Union. The worrisome thing for China in Southeast Asia is that Vietnam and China both have claims to territory in the South China Sea, islands in the South China Sea. Having better relations with Russia for Vietnam gives them potential edge in that competition. Russia has offered support for, say, Vietnam's drilling for oil or gas in the South China Sea. So this visit by Vladimir Putin could indicate deepening ties between Russia and Vietnam, which then could complicate things for Beijing and the region.
Yeah. Well, thank you so much for the comprehensive overview. That was Bruce Einhorn in Hong Kong. Now for a look at some other stories that we're following this morning. U.S. intelligence sources say they believe China's leaders have no clear favorite between Joe Biden and Donald Trump in their likely presidential election rematch. The U.S. assessment is matched by interviews with Beijing officials who think both candidates are intent on containing China. While Trump has threatened higher tariffs, Biden is seen pushing regional alliances against China's rise. And Citigroup says jobs in the finance industry are likely to be affected by artificial intelligence more than any other sector. About 54% of jobs across banking have a high potential to be automated, according to a new report on AI by Citi. On the flip side, that will likely open the way for new positions as AI managers and compliance staff. And a Mexican-themed fast food chain in Australia is set to be Sydney's best IPO debut since 2020. Guzman y Gomez jumped as much as 39% in its first day of trading on the Australian Securities Exchange after shares were priced at $22 Aussie dollars per share. Now, the chain has grown from a single restaurant in 2006 to 185 across Australia, Singapore, Japan, and the United States, with plans to open between 30 and 40 new joints each year. Just looking at the B-roll makes me very hungry. All right, also coming up on our show, South African stocks are heading for their biggest advance since the end of 2022 as investors cheer another Cyril Ramaphosa term. We are live in Johannesburg with the latest. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersetti in Dubai. South Africa's benchmark index is heading for its biggest advance since the end of 2022. Investors are feeling optimistic as Cyril Ramaphosa prepares to begin his second term as president.
I will work with everyone to reach out and work with every political party and sector that is willing to contribute to finding solutions to the challenges our country faces as we transition to a new decade of freedom.
And Bloomberg's Africa correspondent Jennifer Zabazaja joins us now from Johannesburg for more on this. Jen, what was Ramaphosa's main message to voters yesterday?
Right, Jumana, this was really a conciliatory message from the president, and we could surely see that throughout the day as he was dancing and smiling and, just speaking in front of a number of African leaders. But really, he did say that this was the voters deciding to choose peace and democracy over conflict. That was, of course, the concern going into this election, potentially what would happen if the ruling ANC were to lose that majority. And he's saying that, what this result now means for the country is that no, there's not going to be one single party governing over this country, but multiple parties. So really trying to sort of put aside the previous rivalries and the conflicts between the parties and show that he is ready to start governing with these other parties. Now, the question is, what does that actually look like in practice? Of course, we are waiting to see what are the cabinet positions that he is going to decide on, whether or not he's going to keep his large cabinet that he has right now, and also where are the concessions he is going, what are the concessions he's going to be making to some of the other rival parties that are now in this government of national unity. He's surely going to have to do that since the ANC is not the majority, and especially because investors are paying close attention to how the makeup of this government is going to help accelerate and continue to increase a lot of the reforms that he had started in the previous term.
Yeah, it's certainly going to be difficult to get to consensus on many of those signature elements that he spoke about. But of course, now he is back as president again. He's got to focus on the business at hand. The economy is again on people's minds. Yesterday, we had a CPI figure come out of South Africa. In general, has the news that has come through over the course of the last few weeks been good news or challenging news for this new administration?
It's seeming like, on the whole, Jumana, it is relatively positive, especially, you were mentioning at the top there, the reaction in particular with the benchmark stock index. We've also seen the rand strengthening. It continued to strengthen yesterday after this inauguration. And so when we just talk about CPI, a lot of the analysts, when they're looking at the rest of the year, they're thinking that potentially we'll see inflation cooling even more if we do continue to see the rand strengthening, and also seeing food prices and fuel prices potentially easing. And so potentially, yes, it does make it slightly a better situation for this incoming government. But still, this 5.2% is above where the central bank wants it. They're very intent. We've heard the central bank governor talk about this 4.5%, which is smack dab in the middle of their 3 to 6% midpoint range. So there is still a way to go. But now that this government of national unity is formed, potentially a lot of the uncertainty around whether or not government would be able to work together in order to institute some policy and economic reforms is alleviated now, taking some pressure off the central bank. The question now, though, is will they begin to start cutting? Our Bloomberg economist here, Yvonne Mango, does believe that we will see a cut by the end of 2024. Some analysts here in South Africa are a little bit skeptical about that. But yes, I would say it is relatively good news, especially when we look at food prices easing in May and continuing to potentially ease with a stronger rand.
Excellent. Jennifer, thank you so much for that overview. Jennifer Zabazaja, Bloomberg's Africa correspondent, joining us this morning on Bloomberg Horizons. Also coming up, as the war in Ukraine rages on, defense spending is rising in many parts of Europe. We're live in Norway with more on the bloc's new defense reality. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. As the war in Ukraine grinds on and questions loom about what a Trump presidency could mean for the NATO alliance, politicians across Europe have woken up to the new reality for the continent, that is the defense reality. This has sent defense companies soaring, but the gap between rhetoric and battle-ready hardware remains vast. Closing it will take a combination of money, political will, and time. Today, Norwegian defense giant Kongsberg opens a naval missile factory outside of Oslo. Kongsberg is the second best performing stock year to date on the Stock 600, giving a sense of how this push is also reshaping markets. Now, Bloomberg's Oliver Crook is at the opening of the company's new factory in Kongsberg, Norway. I had to Google where Kongsberg is actually on the map, not that far away from Oslo. But Oliver, just give us an idea of how this small town in Norway is key to Europe's overall defense strategy.
Yeah, Juman, it's sort of interesting, sort of arriving here, you drive through a very sort of quiet, small town, and you realize that actually this is the site where they build these huge joint missile strike and naval strike missiles that are sort of outfitted around the world for militaries around the world. And today they're opening a sort of new factory to do that. And we talk about the military build out in Europe a lot. We hear a lot from politicians, but there is a gap between the sort of reality of actually building this hardware and what we're hearing from people. And as you say, money is a huge part of this. If NATO is going to hit its 2% target, just back of the envelope, that's $1 trillion a year worth of spending. If you're going to get to closer to 4%, which a lot of people have been saying, is what is required and is what Norway's goal is going to be eventually, that's closer to, $2 trillion every single year. So there's the money aspect. There's also the question of political will. This is absolutely key for these companies. They need to get the contracts today, but they also need to have the confidence that there will be contracts in the future in order to build out their capacity to get that volume up. This factory, for example, is going to have some new features to it. It's going to be able to scale up and scale down. This is not a traditionally high volume industry, so this is sort of very important and sort of part of the new reality here for Kongsberg and all the European defense system.
What people don't realize, unless you look at the map, is Norway actually shares a border with Russia, which is interesting. So how is Norway addressing their own defense at this point?
Yeah, so for Norway, it's been a huge concern. Obviously, sharing a border with Russia. It's a very wealthy country with its sovereign wealth fund, the biggest in the world, and it's also obviously a member of NATO. So there's been a lot of concerns here about basically also oil fields and gas fields and all the sort of civilian infrastructure that can also be targeted. But it's also sort of interesting because Norway is also the home to the sort of Nobel Peace Prize, and it's a place that really prides itself on progressive values. And its sovereign wealth fund, despite being the biggest in the entire world, has a lot of constraints around what it can invest in on a number of sort of defense companies. So is that a kind of conversation that needs to come into the fore? So we'll be speaking to the CEO here a little bit later, also to the Deputy Defense Minister, and deal with all these topics.
Excellent. I really look forward to that. Oliver, thank you so much for taking us on a trip to Norway, to Kongsberg. Oliver Crook in Kongsberg, Norway. Well, that is it for our show today. That was Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai, but stay with the channel for Daybreak Europe. This is Bloomberg.